Hello, welcome Accounting 101 students to our tutorial on merchandising. Merchandising has been an economy driver for the past 30-40 years and a very important way on how we get things in our society. I want to start off by going over purchases. We'll do purchases separate and then we'll come back and I'll put one up for sales. When we're buying merchandise inventory, we'll get this asset here, merchandise inventory. It's a catch-all for everything that we're doing. All costs pertaining to purchasing and getting inventory ready for sale is accounted for in merchandise inventory. So I want to go over a simple formula that we have here. We have our purchase. We purchase merchandise inventory at cost. In this case, $150. We could have purchase returns and allowances. If we find something that's damaged or something that we didn't want, we can return it. So the purchase minus the return or the allowance will give us a net purchase. They may offer a discount for early payment. If they do, we'll get the net purchase minus the purchase discount, and that will equal the cash payment. The cash payment and the purchase discount will equal the net purchase. You may have a transportation expense if it was transportation in FOB shipping point, which means title passes at the point of shipping where we bought it from, so we're responsible for those costs. Always account for those separately. Here we've got the transportation in for $20. You'll see in our journal entry that the cost will go into merchandise inventory to come up to cost of goods sold, the total cost of our merchandise inventory. But a payment out to cash, because it's probably a secondary transportation, UPS, those type of things, postal service. So again, purchases minus purchase returns and allowances equals net purchase. Minus purchase discount, any purchase discounts that are offered and taken, equals how much we're actually going to be paying for this merchandise inventory. Plus any transportation in equals cost of goods sold, the cost of the merchandise purchased, how much it cost us. Now when you're, be careful when you're applying the purchase discount. It's usually in a percentage. So purchase discount is applied to net purchase only. Okay, say purchase minus purchase return and allowance. Make sure you do not apply the discount to the transportation in. Okay, they may have an accounts receivable, accounts payable for the total, but always account for your transportation separately. So again, purchases minus any returns equals net purchase, and then at time of payment, you may have a purchase discount. Subtract that out, that'll be your cash payment. So let's take a look at this from a journal entry perspective. A, B, C, and D. Here's your merchandise inventory. So you'll see that we add purchases and we subtract out, we credit for purchase returns and allowances. An allowance is a return that you don't have to return. Maybe you got something through the mail and it was too expensive to return, so they just say throw it away. So that would be an allowance. Same thing, it's coming off our bill. So we subtract out purchase returns always first, and then purchase discounts, which will come at the payment time. So we'll have different transactions. So the original purchase, we purchased $150 worth of merchandise. Now it could be a cash payment. Okay, usually not. Usually it's a accounts payable because of other transactions. But notice, here's my debit, here's my credit. Assets, one increases, one decreases. But if we're going to owe it, we're going to take it on account. and the term you'll use is on account. The purchase is debited for $150. Merchandise inventory, everything, it's the capsulation for everything. So merchandise inventory be debited for $150, and accounts payable will be credited $150 for the purchase. Now, when the purchase came in, maybe we found something defective, whatever, we had to make a return. So at that point, we return the B, accounts payable. We're going to reduce our accounts payable, or debit it, by $50. That's how much the value was of the return. And we're going to credit or reduce merchandise inventory by $50. So here's our debit, here's our credit, the accounts are affected, an asset went down, a liability went down. So we purchased, and we have a return. So our net purchase is $100, okay? Then comes C, accounts payable, cash, merchandise inventory. It's time for payment, okay? The debit, accounts payable, has to come off for the full amount, $100. Okay, so we'll be debiting that. So now this becomes zero. We no longer have a bill with the company. They offered a, looks like 2% discount or $2 discount. So again, discounts are applied for merchandise inventory. The discount is usually applied for early payment or payment within a certain amount of days. So our bill comes off for the total, so we owe nothing. But we're going to pay them $98, and we're going to credit merchandise inventory or reduce it for the cost, because the cost is reduced by the discount. So accounts payable, debited for $100, cash, credited for $98, we're making the payment minus the discount. And then if there was a transportation cost, transportation in, as we have here, we're going to add it now, because it does add to the cost of goods sold. We're going to debit merchandise inventory for the transportation cost, and we're going to pay cash to the postal service for delivering our package. So this is a full transaction of what goes on. Remember, merchandise inventory is a catch-all for purchases, returns and allowances, and discounts, and transportation. The $150 minus the $50 minus the $2 plus the $20, as we see here, cost of goods sold is now $118. That's how much it cost us for that merchandise inventory, so that now we can sell it. I hope this tutorial was well received. If you have any questions, please email me, and I will be putting one up shortly for sales. Thank you. Have a good day.